Hi, this is Mike Larson from Money and Markets TV. U.S. stocks have been trending higher for the past few weeks, but I still remain leery of the rally because my indicators are telling me that this is not the start of a major new run. One indicator I watch closely is the Institute for Supply Management's Manufacturing Index, which tracks domestic production. Now, historically, this index is closely correlated with the Dow Industrials, but as you can see, there have been two big exceptions to that rule over the past decade. The first was in 2007, when stocks managed to levitate despite a slow, steady downtrend in manufacturing activity. The second divergence is happening now. The ISM index has slumped to the same level it was in the summer of 2009, yet the Dow has still managed to rally. Now, in hindsight, the first divergence should have been a warning to sell stocks before the sickening plunge that followed. So shouldn't you take the same warning to heart this time? Now, if you want more evidence, just look at the bond markets. Bond traders are usually more level-headed and focused on fundamentals than stock traders, and they're often ahead of the curve when it comes to major trend changes. That's why I'm paying very close attention to the 2-10 spread. This is simply the difference in yield between 2-year treasuries and 10-year treasuries. Now, when the economy is expanding and demand for money is strong, this spread widens out. When the economy is weakening and demand for money is falling, it narrows, and it's generally a very accurate recession warning when that spread goes negative. Now, over the long term, stocks tend to track this expansion-contraction indicator, and that makes sense because profit and sales growth expand and contract with the economy. But right now, the spread is diverging, telling me that it's only a matter of time before the stock market corrects downward to reflect what the bond market is telling us. Still not convinced? Well, in that case, you probably haven't been paying attention to corporate earnings, which are supposed to be the lifeblood of the stock market. Now, recently, year-over-year profit growth in S&P 500 companies, excluding volatile financials, has been dropping like a rock, from 17.2% in mid-2011 to 4% in the first quarter of this year. And the second quarter is looking even worse. With about 90% of S&P 500 companies already reporting, earnings are shrinking at a 1.6% rate, the worst performance in 3 years. Yes, stock investors are ignoring this warning sign too, sending the S&P 500 up to about 1,400 points in just a few weeks. So what's driving this latest round of buying? Simple. Hopes for more quantitative easing by the Federal Reserve and more bond buying from the European Central Bank. But I'm not convinced that's going to happen. And even if it did, I believe it would do nothing to prop up the real economy or corporate earnings. So outside of a few selective picks here and there, you're not going to find me chasing stocks. I'm Mike Larson from Money and Markets TV. Thanks for watching.